Yeah. So I'll get into it. Reklaim, symbol MYID or MYID, trading on the TSX Venture, provides an ecosystem for consumers, providing them with the ability to view, edit, opt out, and be compensated for the use of their data. Reklaim aspires to be the destination that consumers visit to reclaim control of their online data. The shares are up roughly 260% year to date, currently trading about 9 cents a share, with a market cap of just over 10 million Canadian. The stock is really trading down on the year until its Q2 results, down or flat, I should say. But zooming out, the stock is still substantially lower than its pandemic high of 72 cents. Even after that jump in Q2, it's still just a fraction of what it was during that pandemic mania. So, looking at the last quarter, the company had an all-time revenue of just over $1 million for the quarter, a 62% increase year over year, which 93% of that is classified as recurring revenue, which is always a good thing to see when you're seeing recurring revenue. The company's gross margin improved to 80% from 71%. The company did post its first positive earnings of $255,000, driven by its revenue growth as well as cost reductions in its operating expenses, as the company really streamlined its infrastructure and removed a high-cost data vendor, which it was previously purchasing from, which saved them about, I think it was about $250,000 just from that change. Going forward, the company expects tailwinds from increased data privacy laws, putting requirements on data collection, which they navigate through. So a promising quarter as far as the income statement. However, the balance sheet's a different story. At the end of the quarter, the company held cash of $190,000 with debt of $1.1 million, resulting in a net debt position of about $900,000. Majority of the debt is based on convertible debentures with a significant effective interest rate of 21.9% at the time of issuance. The company did announce another conversion of this debentures on the 24th of October of which was of $100,000, which I believe was the remainder of the debentures held by the CEO, Neil Sweeney, as he was one of the two major parties that purchased the debentures initially. So likely just working out the math, he had $100,000 left. You see a news release for $100,000 being converted. Put two and two together, he's likely converted his entire position to shares. So, past direct debt, the company has had significant accounts payable of about $2 million at the end of the quarter, but reached a settlement after the end of the quarter to lower its accounts payable by $500,000 as they disagreed with what they were billed for, and obviously they were corrected. It didn't say they paid anything for it, so likely it was just written off or just completely incorrect invoicing. Using that figure, the company does have a current ratio of about 0.7, which is not good, and it indicates the company may need to raise more cash in the near future. However, management does claim in their Q2 earnings calls that they do not expect to need to raise more capital at this time, as they believe they were able to fund the company's expenses with operating cash flows going forward. But cash management is obviously a significant risk at this time. A quick look at the company's share structure, as it has either used direct equity or convertibles to fund the company over the past few years. Over the past 12 quarters, so 3 years, the company's outstanding shares have increased from 52 million to 112 million. So significant dilution to say the least. Potentially as well, there is more dilution on the way, even if they don't need to raise more capital, as they have remaining convertible debentures outstanding. The exact dilution depends on the stock's price at the time, but at the current 9 cents, you'd be looking at about 11 million more shares, 10% or so more dilution at any time potentially. So, our take, it is a good thing to see that they're shifting into profitability, especially with the recurring nature of their revenue, but the company is just teetering on that edge of needing to dilute more, and if anything interrupts the profitability, whether it's management's fault or something completely external, they would likely need to dilute or raise some sort of debt, which in their case would likely be more convertible debt. So going forward, we would like to see continued profitability with positive cash flows, able to pay down their debt and improve their working capital to de-risk the balance sheet. Right now, it's just quite risky with where their balance sheet is positioned, and even though they do believe that they will be profitable going forward, you can't really base that on one quarter, because if anything does happen, obviously that would completely derail the company and the management's expectations. So for now, we'll just continue to monitor the stock.
Yeah, it's wild.
Sorry, you go.
Canadian standoff. Okay, I'll go. It's crazy that they're paying, what was it, 22% interest on their debt, and it's convertible debt. I mean,
Yeah.
usually converts are, you'll pay a lower interest rate usually or generally because it's giving the
I
bondholder,
believe it was
the
a
advantage.
12% coupon on the face, and then the effective was the 21.9.
Okay, I
Yeah.
see. I see. Makes sense.
Yeah, no, it's interesting to see them move into profitability. Sometimes when you look at these companies, though, we look at the shares outstanding just to see in terms of revenue on a per share basis what they're doing. There's about 111 million shares outstanding here. So they did roughly a million something in revenue in the last quarter. Like
Hmm.
for them to it's pretty decent profit margin that they made off that to do about 200 something thousand in income. But like what we'd like to see this company is doing like a million in net income to give it like a cent in a quarterly basis, and then start to grow from there. It's just it's a fraction of a cent that they're doing, like 0.02 of a cent or something in that range, right? It's they really, when you don't mind the store in terms of your capital structure, you really have to accelerate revenues. They did tremendous growth in revenue, 60%, like you said. They likely have to take revenues up to 5-10 million on a quarterly basis to start churning out great earnings that would actually power the stock forward. Sometimes, you might see a rollback in terms of the shares of a company like this. And then if the share comes back again and they continue to grow, it might be something that we'd look at. But, they've obviously been funding operations through issuance of shares. Now hit a point where potentially they can grow the business. Minding the store in terms of your capital structure on the way along the business path is something we see companies lacking in many times. You see a company finally break into profitability, but they have 250, 300 million shares out, and they can hardly eke out a quarter of a cent or 0.3 of a cent in a quarterly basis. It just, you're fighting against it all the way, because a lot of analysts won't look at a company trading in the 10-cent range or even 50-cent range or even dollar range, right? So sometimes you have to see a rollback, and then will that cycle continue is the question going forward. If you can then continue profitability from that point. But, when we go through, and right now we're going through every company in Canada on CDAR, one of the things we see is, oh, this business looks interesting. Maybe they're trading in the 50-cent range, but then you see they have 500 million shares out and they're doing 2 million on a quarterly basis in terms of revenue, and the profits maybe 100 or 200,000 on a per share basis. The cash flow just isn't there to support that much higher price often in those businesses. Plus the debt structure on that side of the business. This company has been net debt. So you got to watch all of those things. It's tough being a public company, but the ones that do it right, can really lead to great gains. The ones that do it poorly, it's not going to happen for those businesses.